Hey, Puppy Trades! I wanted to do a video analysis update of the unusual stock options volume for Tuesday, April 16th, today, 2024. And yes, the big one I noticed today, this huge reading was actually a really popular stock on FinTwit. It's one that I get requested a lot. Yes, everyone is super interested in Kirby Corp. Yes, Kirby Corp was the biggest unusual options volume reading. It wasn't a full bowl. It wasn't a full bowl. It was a little cute. Looked like a ratio long gamma trade. We can look at what they bought in a second. But look at that. Oh, man. Everyone asked for lots of updates on Kirby Corp. This oil tanker barge transporter, the largest oil tanker transporter in America. People were real interested when I posted about it. And of course, as it trudged up to my target, I got lots of update requests on Kirby Corp. So that's one reason I wanted to talk about it there. Using some slightly, actually it was about 2/3 to the downside biased gamma positions, long puts and long calls, about 3,000 long calls to 6,000 long puts. So what are they doing? Well, if Kirby Corp goes down a little bit, they can buy against those bloated in the money puts, while retail thinks whatever's going on with Kirby Corp in the Middle East that's causing it and other transportation names in this sector like IMPP, Imperial Petroleum, to rally. Anyway, the real reason I made this video obviously wasn't because of Kirby Corp. There were a few fun ones on the screen. So really, I'd say the Strangle screen, probably my favorite screen. I love this screen, though, the unusual stock options volume screen. I sort by the lowest put call ratio. And even before I refresh it, I like looking at the ones that made it before I refreshed it. So Nano Dimension, PaySign, I thought had an interesting chart. CX, more of a uptrend play, not really a super cycle low. Sanofi Aventis, I thought was really interesting. And don't get me started on another energy stock. We can't do another energy stock. Sorry, no more energy stocks for at least like 3 days. Okay. So anyway, Nano Dimension and Sphere Entertainment and Sanofi Aventis were on this screen. I thought they had pretty cool wave counts. I know Nano Dimension is a FinTwit favorite. FinTwit. All the FinTwit favorites are growth, by the way. Not the best for portfolio management, but that's why no one on FinTwit ever trades based off what they see, because no one on FinTwit is giving financial advice. I, of course, trade off of everything that I post. Basically, every single thing that I post directly has some effect on my analysis of why I'm going to make a purchase in my brokerage account the next week or so. Anyway, Nano Dimension, just for my personal notes, it had an unusual options volume reading, so let's go check that out real quick. What was going on here? Nano Dimension had 1,000% unusual options volume, over 99% call bias, and they were leaps. Woo! Not too hard to figure out what this guy wants to happen. What's the short borrowing fee if these were married calls and they were shorting an equivalent number of shares of Nano Dimension? But yes, that right there is the leap trade that got Nano Dimension on this screen. Almost all of those contracts, that's about $470,000. So yeah, 470 bands. You got enough money to get on one of my option screens. I might be talking about your stock. Anyway, obviously, don't do that. So, Nano Dimension, I believe, has formed a 5 waves impulse. 1, 2, 3, 4, 5 waves up. An ABC correction. And for these time fibs, I started at the beginning of wave 1, and I connected it with the end of wave 1. So pretty logical there. We've got that 5th Fibonacci weekly time fib coming up. I did invent this, so if someone says he made this up, yes, I did invent adding time fibs to Elliott wave counts. That was me. You know, I was talking about the required reserves ratio being 0 for about 2.5 years before I saw a single other FinchWit person talk about that. And then I saw like a lot of huge influencer accounts all randomly decide to start talking about the required reserves ratio. I was like, I am in the twilight zone right now. FinchWit is talking about the required reserves ratio. They're talking about chocolate prices. We're not going to be talking about chocolate prices and even gold anymore. It's going to be things people actually spend their money on. PICK, I posted about PIC, an ETF that tracks metal miners that focus on things outside of gold and silver, Alcoa and aluminum, copper and copper mining. Yeah, the inflationary side of the market that people actually spend their money on, can't really get out of paying for, can't really just, skip the metals and the aluminums like they can skip chocolate and orange juice. Anyway, I'm not planning my breakfast. 1, 2, 3, 4, 5 waves up. Wave 1, wave A, and ABC for Nano Dimension. Will there magically be a wave 3 or wave C impulse right around this time fib? We'll see. This guy bet a good amount of money. And when did his options expire? They expired January of 2025. So the invalidation for this is 2.06. And then this might be a little wave FUBU. But even from this low, my preferred time frames for counting are the 3 to 5 month weekly and the 10-year monthly or the 20-year monthly. And with option premium collecting ETFs, that's a great way for me to do it. With closed-end funds, that's a great way for me to do it. And with these jacked up interest rates, that's a great way for income-oriented people like me to do it. And now, income and total returns are becoming synonymous. One of my posts was going to be that YMAX might have finally did it. YMAX running all of the Yield Max ETFs in an equal weight bucket. And those are all 5 to 15% out of the money synthetic covered calls. It's beat blindly averaging into the NASDAQ since its inception, and it's paying about a 33% dividend yield. So I'm definitely going to be buying it. I'm planning on buying YBTC tomorrow, and I'm planning on buying GOOP and AMZY. YBTC is the Bitcoin covered call ETF. AMZY and GOOP are from Curve, similar to the Yield Max ETFs, but slightly different expirations. They run out of the money synthetic covered calls. Anyway, because of the way those expirations are set up, it's a way to get 2 dividends from Amazon, 2 dividends from Google, assuming those stocks stay afloat. Anyway, I'm a big fan of AMZ and AMZP. I think I meant to say AMZP and GOOP. Those are the Curve ETFs. But YieldMax also has AMZY, which does very well on its own. And it also pays a high dividend. And the way that AMZP and AMZY are set up, 2 dividends can be collected each month from Amazon. I think that from this low on the daily count, we'll get a little bit of evidence for Nano Dimension, I think. So, yeah, above 2.06. We'll see if it earns the fervor that Finchwit has for it and whatever this bull has for it. Sphere Entertainment. No, I'm going to tease y'all. We're going to do Sanofi Aventis, the boring one, first. What was the unusual options volume here? Sanofi Aventis. $521 unusual options volume. I haven't checked this yet. Way out of the money front months. Expiring next week. More out of the money for the week after that. And more out of the money for 2 months after that, or 1 month after that. So, yeah, this guy bet a lot of money that Sanofi Aventis is going to 47.50. Is it a straight gamble? Not quite. Sanofi Aventis pays a little bit of a dividend, and those options aren't too far out of the money. There's a chance this guy could be a huge whale, and he's actually just buying the gamma. This guy could be such a huge whale that he's actually worried, he or she is actually worried about Sanofi Aventis running off because they want to lock in this dividend. So the way I suspect that they're looking at this is that they're buying these options because ideally they want to have a portfolio where each of these options hypothetically would be exercised. So that would give them 1720 plus 850 plus 1,200. So they may be worried that Sanofi Aventis is going to run off. If all of these options were exercised and Sanofi Aventis went above 47.50, each of those contracts would give them the right to purchase 100 shares. So why might they be doing this with Sanofi Aventis? Well, because if Sanofi Aventis goes up past 47.50, that yield for the dividend is going to go down. So they may legitimately just be buying time. It's really probably one of the more responsible ways the MMs use options instead of just trying to abuse the options chain and force a gamma squeeze based on their expertise, right? Anyway, Sanofi Aventis, I've got all types of crap for it. But I think it's got a pretty clean count. Now, the long-term count, just to be honest, is the cleanest. This is a huge long-term count. And that's why this kind of paying a massive dividend is a big appeal to it. But that's also why patience is going to be a big appeal to it. Don't get confused if you see that I'm doing wave 1 and wave A. I really explained that dynamic in my last video on the Dow Jones pretty thoroughly. This is just something that I do just because if this was wave A, wave B, or wave C, or wave 1, wave 2, or wave 3, the argument that I'm making, I just really do this out of habit, is that, yes, the 100% extension's been reached, so, that wouldn't really be this wouldn't really be the best example, but let's say the 100% extension hadn't been reached. This would be an example of incompletion. So, like I said, I just did that habitually. Where might it make a little more sense on this chart to have labeled this as a wave 1/wave A? It would have been actually this degree right here. And I'll talk about why. Wave 1, wave A. Wave 2, wave B. So we make this new high. So has it reached the equal legs target for wave 3 or wave C? The answer is no. The length of wave 1 placed at wave The wave 2 low hasn't been met for wave 3, and the length of wave A plays with wave B low hasn't been met for wave C. So that's 69 in the long term. That alone, to be honest, would be enough for some Elliotticians to say, yeah, I'm going to buy Sanofi Aventis until it reaches and collect those dividends, which will probably grow with the share price if things are going well until it reaches 69. Obviously, that's complete speculation. They could cut their dividend at any time, but typically, the best my kind of holy grail for that type of thing would be the dividend does grow. These foreign stocks, though, the only thing I'll say is that whereas in America, cutting your dividend is very taboo, not even having a consistent dividend and changing it is taboo. In foreign markets, because of how they report at slightly different frequencies, they might not report the way that they are just set up. Paying a growing quarterly dividend and making it consistent and even growing it at a similar pace is not something that the foreign investors and the foreign CEOs are as picky about as we are in America. Anyway, I would love to see Sanofi Aventis go up to 69 and pay a growing dividend. What I'm trying to say is that in Europe, that's not as big of a priority. So anyway, one wave 2 on the largest degree, a large wave 1 and a large wave 2, another wave 1 and another wave 2. I believe Sanofi Aventis is incomplete until it reaches 69. Just because I enjoy charting, I'll count this out. This is a leading diagonal from this low. This is wave 3. If you guys want me to go more in depth into why something's a leading diagonal, I can. It's really, just to be honest, the one time where Finn Twit will draw a rising wedge and they'll be right. When a rising wedge does form and it takes the form of 5 waves, typically what the bears say, if it's forming these contracting lines, that it's a bear signal is correct in the short term if they're Elliott wave theorists, because ideally it's a 1, 2, 3, 4, 5 waves. We don't call it a contracting, or we don't call it a rising wedge. We call this a leading diagonal. So when the bears say that a rising wedge with these contracting lines, they won't say it takes the forms of 5 waves because they're not doing wave theory. When they say that it's bearish, they're partly right, but a bull for wave theory is actually going to be seen as more of a bull signal, because that 5 waves impulse forming is a leading diagonal for wave 1. Yes, there is going to be this bear wave 2 move, but it's kind of known by wave theorists, that at least suspected, that the wave 1 high, the wave 1 low is not going to be broken because it was a 5 waves impulse that was a leading diagonal. And so this wave 2 is actually going to end up being a big buy, which I believe it was. And so, yes, I believe Sanofi Aventis is nesting. Woo! So I think the 78.6% retracement. Look at that beautiful 61.8% tap for wave 2 ending. 57.82. $36.91. And I'm looking for Sanofi Aventis to hold above 41.38. I'm going to say that's tight. That's kind of just right, though. 36.91. Too wide, I'll say. But yeah, I'm expecting Sanofi Aventis to go 1, 2, wave 3. And just for portfolio theory, the reason I put Sanofi Aventis, this boring healthcare stock, in here with Sphere Entertainment and Nano Dimension is because I understand that the sexy growth stocks get more fun. And, I'm all about large cap tech, large cap growth, and taking big positions in those growth sectors. But as far as this kind of high beta, small cap type of growth goes, I understand that it's sexier. But I personally take much smaller positions in stocks like this. My favorite way to play growth, just to be honest, is when stocks get down to the $1 or $2 range, like Nano Dimension, and I see these unusual readings. Just because, and I can do a deeper dive video on this. Let's just say, all else being equal, let's say I was just as confident about Sphere Entertainment as I was about Nano Dimension. I had the exact same level of confidence that they were both going to enter wave 3. And let's say hypothetically that Sphere Entertainment's implied volatility, this number right here, was exactly the same as Nano Dimensions. So they have the same implied volatility, i.e. the same options prices relative, all else being equal, and I have the same confidence that they're going to hit. If I had to buy calls on one of them, which one am I probably going to pick? I personally am probably going to pick Nano Dimension, just because something that's kind of a odd thing to think about. Sphere Entertainment is $40 per share. Nano Dimension is about $2.50 per share. Now remember, that doesn't technically have any impact on market cap. That could just reflect reverse splits or stock splits. So knowing that a stock is $3 per share doesn't tell you what the market cap is. And if the implied volatility is the same and the confidence in the setup is the same, why would I pick Nano Dimension over Sphere Entertainment? It's just because Sphere Entertainment is $40 and Nano Dimension is $2.50, I'm going to get to control a huge amount of shares of Nano Dimension for a very small amount of money. In other words, and you can test this yourself. The next time an ETF that's an inverse ETF is about to have a reverse split. Let's say it shorts something like the NASDAQ, it shorts semiconductors, and it's about to have a reverse split, right? It's going below 5, it's going below 3. Look at what happens. It's the same instrument, it's the same ticker. Before the reverse split, look at how much gamma an option buyer is going to be buying on calls and puts compared to how much theta they're going to be buying. When the share price is very, very low, remember, this doesn't have anything to do with the market cap. When the share price is very, very low before a reverse split, the gamma on the options being bought is going to be super high. The theta is going to be super low relative to what happens after the reverse split, where if someone woke up 3 weeks later and they're trying to buy these same options, the options are going to be adjusted during the reverse split. So the options market during the reverse split is going to take away that, it's going to adjust the option. But if someone wants to enter long gamma positions this is just to kind of illustrate. After the reverse split, if someone were to then start looking at straddles, you're going to see, because the stock has gone from, say, $3 a share to $30 a share, that the gamma on the options, which is really good for the buyer, is now a lot lower. And the theta for the options, which is really bad for the buyer, is now a lot higher. And that's only because, not because of market cap, not even because of implied volatility, just because of the share price. It's a little bit to wrap your head around, but basically the idea, here's where it gets practical. Let's say one day we woke up in a world where a single stock ETF on Apple was extremely liquid. It was a 1.5 inverse leverage ETF. So it's doing the opposite of Apple by 1.5%, and it's extremely liquid. And so because Apple's going up, this ETF has fallen from 15 to 10 or 15 to 12. And Apple has risen up to 200, 220, right? and I want to take a new bullish position on Apple. I think an ABC correction's ending. Well, if I buy calls on Apple when it's at 220, I'm going to be paying for tons of theta, and I'm going to get very little gamma. But if I buy puts on the inverse ETF that's shorting Apple, that has fallen to $12 a share, and I'm betting that it's going to fall to $10 a share or $8 a share, the options that I'm going to buy are going to have very high gamma, which is good for me. And they're going to have very low theta, which is also good for me. And because the decay of the inverse leverage ETF, if Apple does start going my way, just because time's going by and leverage decay, it's going to be harder for that option to recover. Anyway, Sphere Entertainment. It was better talking about that than the fundamentals of this stock. Because if you remember, this is the stock that has that goofy building in Vegas where they spend a crazy amount of money on that. So we'll see. I think they're losing a balloon ton of money on that. 51.83. So I'm not sure what these MMs are thinking. We'll make sure we got the right options. I thought this was a pretty clean count. This low down here is 27.02. The investor bets, it was a 398% unusual options volume, over 98% call bias, and the strike prices and the expirations we'll see right now. I think they were these Junes. Yeah, nice little reading for June. Was it August? July, nice little reading. Yep, so 398% unusual options volume. No front months. None for 517. Yeah, it looks like they're playing the June expiration. Look at these out-of-the-money options. Pretty far out of the money. Pretty far out of the money. It looks like they're expecting a big rally by June. I'm going to tell you what I think they're doing. Elliott wave. I believe Sphere Entertainment formed a 1, 2, 3, 4, 5 waves impulse. Real clean subdivision. An A, B, C correction. Ending at the 127 to 161.8% extension of the length of wave A, places wave B high, where wave C ends. These more volatile growth stocks, they're going to get closer towards that 161.8% extension number. As far as the other way to find the fibs, the depth of wave 2 is usually between the 50 to 61.8% retracement. A more useful level for a high beta growth stock is going to be this wave 1 high, 35.49. That's pretty close to the 61.8% retracement of 36.50. So while Sphere Entertainment is above 35.49 to 36.50, I believe it formed a wave 1 and a wave 2, and it's going to begin a rather explosive wave 3. If wave 3 ended before those levels that I said, Sphere Entertainment could be heading into the low 60s.